All right. Good morning again, folks. Alan Mercurio here with Mercurio Wealth Advisors, sharing some ideas with you this morning. Welcome to our retirement readiness webinar series. This is our second webinar, so as you can tell, we're a little bit rusty with the technology, but we'll get better about it, and things will start to smooth out over time. If you'd like to check out our first webinar, you can go to mwawebinar.com. That was a webinar that I did about a month or so ago on understanding market corrections, and fortunately or unfortunately, I guess, it was right before the market corrections. So one of the things that you can do is go back and review that and kind of get some ideas as to what you might be wanting to do right now with your portfolio right before the end of the year. I wanted to go through some things that we are doing for the next few weeks through the end of this year and then starting into next year. So we are going to continue doing the webinars. Next month, we'll do one on December 19th. Right now, it's kind of a surprise, but I think we're leaning towards kind of a year-end review of what's happened in 2018. We'll also talk about what's going on in 2019, have a look forward to that and see what things that you need to be focused on in the first quarter and how you can kind of get started with a good year. Last night we had another bang out seminar over at Ruth Chris seminar. We had that sold out. Every time we do one of the seminars over at Ruth Chris, it seems like everybody comes in obviously to get a nice steak, but they also come in and get a lot of good information about our process and how we do that. Next year in 2019, we're going to add some other topics in there. One of them that I'm working on right now is 5 critical must-dos that before you retire. So some of the things that you really should look at right before you retire to get that ready or be ready for retirement. And then also we'll be adding on some additional topics next year, possibly a couple new locations as well to give people a mix-up of where they can go to kind of see that. We're also doing educational classes over at the University of Louisville campus. We've been doing those since about the end of August. Troy's been handling those here at the office. And one of the things that's kind of got this started was what we're talking about today is really the tax planning aspect of your retirement plan. Troy has had every class that we've had over there has been sold out. So if you want to come to one last tax class, now today that's what we're going to talk about. Today I'm only going to get into about 30 minutes and just a couple topics. Troy takes a more expanded look. Usually it's about an hour to an hour and a half of information that you go through over there. There's no cost, but it is a first come, first serve. So if you want to go to that next class, it's going to be on December 3rd. So that class is going to be, you can go to our website, mercurioadvisors.com and sign up for that if you'd like to, or you'll have a phone number here at the end that you can call in and get signed up for that as well. And also one of the things that we're going to do with that class is we're actually going to have that class here in our office. So we put together a really nice classroom setting here in our office. I think it's going to hold about 20 to 25 people or so. So hopefully you can get in and go through that class with him. And then if that weren't enough, then we also are working on an online course. So for folks that really can't take advantage of or can't get enough of this information in a timely manner, we're going to have an online course that you can actually purchase for a small amount where you can actually go through a quick course to kind of get you up to speed and get ready for retirement. I think that's the key part about all this. All of this information, again, you can get at mercurioadvisors.com at the events page. You can sign up for any of these events or for the next webinar. If you want to sign up for the next one, you can go to mwawebinar.com. And so with that, we're going to kind of get started with today's webinar. So let me just turn this off here and kind of get into the meat and potatoes of today's webinar. So really what we're going to talk about today is the 2018 tax changes in your IRAs, how that actually has taken place and what you're actually going to experience going forward with these tax changes. We've seen a lot of benefits coming out of the tax law changes. So that's what the class is all about, and that's what we're going to talk about a little bit today. Before we get to that, let me read a little disclaimer here to you. This material is provided as a courtesy of Mercurio Wealth Advisors and contains general information to help you understand basic tax planning, strategies, and considerations. Nothing I say should be construed as a recommendation to buy or sell any financial vehicle, nor should it be used to make decisions today about your investments. I am a licensed insurance producer and an investment advisor representative of Mercurio Wealth Advisors. And my goal with this presentation is really to expose you to ideas and financial vehicles that might help you work toward your financial goals. Please understand I cannot make any promises or guarantees that you will accomplish such goals by this presentation. Investing always involves risk, including the potential loss of your principal. Past performance is no guarantee of future results. Investment advisors services are offered through Mercurio Wealth Advisors, a registered investment advisory firm. Neither the firm nor its agents or representatives may give tax or legal advice. You're encouraged to consult with a qualified professional before making any purchasing decisions. And despite the efforts to be accurate and current in this presentation, some things may be out of date, and we are under no obligation to advise you of any subsequent changes related to the topics discussed in this presentation. It is designed to be educational in nature. So with that, one of the things I will remind you is that a holistic retirement plan really involves more than just tax planning. It involves income planning, investment planning, of course, the tax planning, healthcare planning, and estate planning. What we have created here at Mercurio Wealth Advisors is really a process we call the Retirement 360 Game Plan that helps you look at all of those and trying to stay with the theme of that 360 game plan. We involve your estate planning attorney, your CPA, your tax professional. We help with the income, building the income plan and building an investment strategy. So keep in mind that your income plan is probably your number one thing that you got to have in retirement, but everything else has got to work with that, and it's got to work together. So that's what we try to focus on in our holistic approach. If you're working with another advisory team, that's what they should be focusing on too, or you should demand that as well. So you need to go back and say, hey, you know, get with my CPA or get with my attorney and make sure this is all on track and all on point so that it works together. Otherwise, you could end up, you know, having some surprises, which are never fun in retirement. So today we're really going to focus on three main things. And number one, the qualified retirement plans. These are the plans that you've had for years, the IRAs, the 401ks, the 403bs, all of those types of plans, the ones that you never paid tax to put money into, that's a qualified plan. They can often lead to a lot of tax-related problems during your retirement years. A lot of us were told that we would pay less taxes in retirement. That's not turning out to be the case. As many of you are probably finding out, or if you're just getting ready to retire, you will probably find that out. Number two, we are going to talk about the Trump tax code and how it maybe offers some opportunities for a limited time to where you can maybe reduce some of those taxes now and then in the future. Not going to be able to eliminate them, but you might be able to reduce some of them. And then number three, we're going to take a look at a large percentage of people that we help that are coming into that retirement stage or maybe are already retired are making the same mistake. And we're going to talk about that mistake and how you can possibly avoid that going forward after today's webinar. So let me ask you a quick question. How does saving tax on $155,000 of income lead to paying tax on over $1 million over your lifetime? Well, what we found is that $155,000 is really the average annual income of the households that are coming to see us. Either maybe that's one person or maybe two, but that's the average income coming in. And if you've been diligent savers over the years, it's very likely as you approach retirement, you could be looking at, you know, an IRA account or a 401k account or a 403b account that has as much as $1 million, maybe more or maybe a little bit less. But the point is that you've got to pay tax on all that at some point. You got to start to pay the tax man. And that's the thing that we're kind of spending time today talking about is how do you either eliminate that or maybe take advantage of these tax plans or the tax codes now to potentially reduce that in the future. Well, the problem that we see is that these IRAs and 401ks and 403bs, all of these retirement accounts, they have a number of different issues. The first one is every distribution is taxed at your highest rate. Now, what do I mean by that? So if you're in a, let's say the new tax code, you're in a 22% tax bracket. Well, that's how this money is going to be taxed. It doesn't get any kind of favored tax treatment like a capital gains tax would be, it's not like, you know, if you bought a mutual fund and then sold it later where you'd pay a smaller tax on that capital gains rate. You're actually going to pay your full tax rate on this. So that's what we mean by you're paying your highest tax rate on it. In addition to that, distributions may put you into a higher tax bracket. So, and again, in a few minutes, you're going to see the new tax brackets for 2018. If you're at the top of the, let's say the 22% tax bracket, and you have to take a distribution out of your IRA account or your 403B, that could throw you into the 24% tax bracket, which is just increasing your tax overall. Distributions often lead to additional tax on your Social Security. So if you've elected to take your Social Security already, let's say you took it at 62 or you took it at normal retirement age, now that you have to take money out of one of these vehicles, that could create tax on as much as 85% of your Social Security income. So you want to be careful as to how that money comes out and which buckets you're drawing from first. One of the strategies that we use in our holistic planning is really looking at the Social Security and when to turn that on. Some people need to turn it on at 62. Some people need to wait to age 70. And all people are different. So you just have to kind of look through that and see which benefits you and your family the most. Number 4, distributions can lead to more tax on capital gains. For instance, under the new tax code, if you have a household income of less than $77,400, your capital gains rate is 0%. So you won't pay any tax on capital gains if you're under that $77,400. However, let's say you have to take a distribution out of your 401k or IRA at age 70, or you just take some money out of the account in general to do something, it could create a tax on your capital gains now that you're over that amount. So you just want to understand where you are at all times and make sure that you're aware of how that's going to could hurt you or benefit you at that point. Number 5, these are the only accounts that require distributions, and this is non-negotiable. The IRS says at age 70 and a half, you have to take money out of these accounts. So it doesn't matter whether you need it or not, you have to take it out. Well, that can create a lot of issues if you're, cruising along and got all the income you need, and now all of a sudden you got to take an extra $10,000 out of your account. It could, again, throw you into different tax brackets or cause a lot of different problems there. And number 6, these are probably the highest tax accounts, or are the highest tax accounts to leave to your heirs. I always say that if you're going to leave money to your family, to your children, grandchildren, any members of the family, these are the worst assets to leave. You want to leave the things that are going to get a step up in basis. So like your mutual fund account that has a very low cost basis. In other words, you put a lot of money or a little bit of money into it and it's grown to a big number. Well, when you pass away, you'll get a step up in basis, or your family will get a step up in basis on that account. So they won't have to pay any taxes on that account. Or let's say your property, your home, real estate that you have also gets a step up in basis. So those are the things that you can potentially leave to your family as opposed to these IRA accounts or these retirement accounts. So there's a lot of different directions you need to go with these, and we can kind of talk about some of those today in our time together. But the result is that these IRAs, again, the 403Bs and 401Ks are often causing more tax than most people thought they would. And they are certainly going to be one of the least tax efficient accounts that you own. So the goal is to try to attack that now and try to start doing something about it while you still have time. So if you're over age 59 and a half, you've got a window from 59 and a half to age 70 that you can really start to do that. And I think that the new tax code could potentially help us here. So let's look at that and how that's going to look for 2018 and for the next couple years anyway. These are the tax brackets for single filers. I'm going to let you take a quick look at that. You can see that there's 7 tax brackets here. I'm going to jump over here to the tax brackets for joint filers. Oop, I got a highlight in there, so that's really what we'll talk about, that highlight. But basically what we're looking at here is the final plan. If you remember when President Trump was trying to create the new tax code, one of the things he said multiple times was that he wanted 4 simple tax brackets. Well, as you can see, it didn't turn out to have 4 simple tax brackets. We still ended up with the 7. And two of them stayed the same. The 10% and the 35% stayed the same, but the numbers changed a great deal. If you can look at those, what we find right there where you see that highlight on your page is that most of the people that come to visit us usually fall in that area, somewhere between the 22 and 24% tax bracket. And that, again, has expanded quite a bit from 2017, as you can see over here. Get my laser pointer here. Last year, if you made it over this 233,350, you were in this 33% bracket. Well, now you still get to stay in this 24% bracket. So many of us are going to have a lower tax bill this year. One of the things that we've been doing from the tax class is running what we call a tax map. And we still have time to do it through this year. If you'd like to come in and go through this process, all we do is take your 2017 tax return, we plug it into the program, and it'll show you what your taxes are going to be for 2018. And it's pretty neat software. And we've also seen another side benefit from that is that we've been able to show a number of people that came in a way to potentially take money out of their IRAs and qualified plans tax-free. So that's a golden rule that we follow here at Mercurio Wealth Advisors. If you can take money out tax-free, we think you need to take money out tax-free. So here's one of the potential solutions that you might be able to look at. And again, everybody's going to be different, but this is something that may work for you. What about turning some of that IRA money into Roth IRA money over the next 2 years? We've got this, like I said, a window of opportunity with President Trump's tax plan at this point. And maybe it makes sense to take some of this money and create a Roth account or a tax-free account in doing that. Some of the benefits to doing that is that once you've created the Roth account, the distributions from that account will be tax-free. Now there is a 5-year rule, and there's two rules to the Roth IRA. You have to hold it for 5 years before you can take the tax-free income out of it, and you have to be over age 59 and a half to take that money out. But if you're already in that age, if you're already over that age bracket of 59 and a half, you have immediate access to the funds that you pay tax on. So let me kind of walk through that for a second. Let's say you've got, $15,000 or $50,000 in an IRA account, and you want to take $10,000 and turn it into a Roth. Well, you take $10,000 out, you move it over to a Roth IRA. Now that $10,000 that you're taking out does become taxable at the time you take it out. So you have to pay taxes on that as you take it out. But it goes into the Roth IRA. Once it goes into the Roth IRA, it starts growing tax-free. So whatever investment that you put in there, which can be stocks, bonds, mutual funds, whatever, it's all going to grow tax-free in that account. That tax-free money you have to leave in there for a period of 5 years. But the after-tax money, the money that you just moved over, the $10,000, you can take that anytime that you want to, assuming that you're over age 59 and a half. So that's a huge benefit to creating these tax-free accounts. Number 3, another benefit to this is that there are no required minimum distributions on these accounts. I like to say that you're taking control of your accounts. The IRAs, the retirement accounts that we've talked about so far, let's face it, we don't really have any control over those. I mean, we do up till now. We can control the investments and all that, but Uncle Sam holds the ultimate key, which is once we take the money out of that account, we have to pay taxes on it, and we have to pay it at our highest tax bracket, like I said a few minutes ago. So what if you start switching that over a period of the next couple of years and get some of that moved over into these tax-free accounts? It could be a huge benefit for you and potentially your beneficiaries in the future as well. Number 4, it is tax-free to your beneficiaries. Your spouse can roll this over without any taxes or charges to them. And at number 5, I think this is a key point here, is that it kind of immunizes everything against future tax law changes. We know, or we feel, I shouldn't say we know, we feel like that once President Trump's term of office is over, whether it's done in 2020 or it goes to 2024, we feel like that there are going to be some new tax laws coming in the future. I don't believe that this current tax the tax brackets and everything will hold through from now on. I think that's going to continue to change. But if you move this money into these tax-free accounts, our belief is that it immunizes you against those future changes. Let's take a look at a quick example here. We've got a married couple that's they're both 65 years old. They're at the top of the 15% tax bracket in 2017. And their goal is really to convert $200,000 of their IRA to Roth IRAs. So if they did this all at one time, this is how it would have actually looked in 2017. The cost of that conversion would have cost them about 28%, a total of about $56,000 of tax to convert $200,000. If they did this in 2018, though, the cost would be 22%, which equals about a 20% savings on the tax. So if you remember the stores, Kmart always did something when they had a sale. They'd run the blue light specials. And that's really what's going on with the tax plans right now, or the tax code right now, is that we do have an opportunity to maybe reduce our taxes. And if it makes sense to you, then it could be a benefit to you and your family. And as the slide says there, obviously everyone's different. You have to go through a process to find out if this is even something that would benefit you. The question is it a good idea to convert your IRA money at less than 25% in taxes? Possibly, but again, everybody could be different. So the thing that you have to be aware of is that the tax man's out there. He's going to take his share. So you got to be comfortable with the amount that they're going to take out of your pocket. And maybe if you do it early enough, you possibly have time for that money to grow back into the account before you actually start using it in retirement. So possible Roth conversions to kind of benefit you from the tax man right at this point in the future. There are some other issues that you have to be concerned with. If you do a Roth conversion, that's looked at as a lump sum of money that comes into your personal economy. So that could change your coverages, or not your coverages, but actually your premium on your Medicare Part B and Part D. So if you kind of take a look here, and I'll get my pointer back out. If you take a look here, if you're getting less than $170,000 a year as a joint filer, and your premium for Medicare Part B should be $134 a month. If you jump over that $170,000 threshold up to $214,000, your premium goes to $187.50 a month. And you can see the sliding scale here. So if you converted a large amount, you could be paying a much higher premium for your Medicare Part B and your Part D prescription plan for a period of time. Usually it's about a year, then it goes back to what it was. So you can, there is a little bit of added cost to make these conversions. And again, being aware of this, or at least working with a retirement advisor that can help you with this, I think is a key point, but so you don't kind of get stunned by some kind of a surprise that happens out there. But I do think that there are some benefits to doing that. Some key considerations is that, again, everybody's different. One of the things that we feel like is a good opportunity for you guys is to take an opportunity to go through a complimentary second opinion review to see that your plan is on track, and to see if it's any of this would work in your particular situation. So getting towards the end, one of the things that we actually see most people that are getting ready to retire, or people that are already retired, make the same mistake, is that most people don't understand that investing during retirement is different than investing for retirement. And what I mean by that is how you actually are investing your portfolio currently. There's three key rules that most people would want to follow going into a retirement type portfolio for retirement. Is number one is protect my principal. I want to make sure that I don't lose money. That's the key rule that Warren Buffett and many of the super traders out there follow, is they just don't want to lose their principal. They want to protect their principal at all costs. Number two, in retirement, you typically want to create some income. How do I generate income out of this pile of money that I've saved over the years? How do I turn it into a monthly paycheck or a weekly paycheck like I used to get at work? So you got to create some income. And then number three, you want to take a chance and grow it every a little bit if you can through the markets, but you just want to make sure that, you remember rule number one in protecting that principal. What we've seen a lot of people do is they jump into these what's called balanced portfolios, And this is what the financial service industry has kind of led us to believe is the best way to manage your accounts in retirement for years and years. And I'll kind of blow up a couple sections of this chart. This is actually one of the charts that will run for you if you come in and go through our process here. We take a snapshot of your current portfolio and kind of help you understand exactly where you are with some things. But let me kind of blow up one of these. The balanced portfolio here is kind of showing you that the asset allocation is, again, made up of a couple of different things. It's made up of U.S. stocks and non-U.S. stocks, typically around 60%, somewhere around that 60% number. And then a typical balanced portfolio is going to have some bonds about 40 or 45%, something like that. Maybe some other asset classes in here, some cash and what have you. But we also see some issues with that. Is that, yeah, you have the ability to make some good money like you did through March of 2009 to February of 2010, but you also still have the potential to lose some money. So I would venture to say anybody that's listening or watching today, if we started a relationship in the first year out of the gate, we were to lose 26% of your money, that's probably not going to go real well. We're probably not going to be working together too long if we lost 26% of your money right out of the gate. So what we've found is if we can help you control this number, then this number over here takes care of itself. So we want to make sure that this is minimized as much as we can. And we've done that by doing it a little bit differently, because there are other people that want to invest the same way. But this particular process was followed because people wanted to lower their risk of losing money. And they also wanted to still have some risk exposure and maybe limit their down years to, -10 or -15%. There are other investors that like to do this the same way. And we found that following these other big investors that have the same goals as we do, we've had pretty good results in doing this. These endowment funds that are out there, the Yale Endowment Fund, the Harvard Endowment Fund, they've invested their money the same way for years and years. And you can kind of see here that in domestic stocks, they limit it to 16, 17%. Now, this is a little bit older chart, but 16, 70% in domestic stocks. That fixed income is way down from that 40% to 9%. They got international stocks in here, international equities. But look what they've actually done here. They've thrown in another category called alternative investments. And alternative investments typically represent somewhere between 40 to 60% of their total portfolios. In this case, it was 51 and 52%. You can take a snapshot of this link down here, and you can go into this commonfund.org and kind of get more information about how these endowment funds are actually investing their money. But what are the alternatives? Well, alternatives happen to be real estate. A lot of people are coming in and have some rental real estate that they're using as an income source, or maybe they're looking at possibly adding some real estate in. You have some pluses and minuses or pros and cons with real estate, and we can walk through those with you as well. People were also seeing a use of commodities. Now people are buying gold and silver and adding those commodities into their portfolio to get a little bit different return as the market shifts around. We're also seeing life insurance used as an alternative to invest. Life insurance, many people will talk about how they've built a tax-free retirement plan out of their life insurance portfolios. Fixed indexed annuities. This is another kind of controversial topic, but people are finding that these indexed annuities are working because you put money into them and then you get part of the gain of the market, but you don't lose anything if the market goes down. It's a nice little added touch there. Writing covered calls. This is a option strategy where if you have a large block of stock, I'm working with a couple right now that has a huge amount of Walgreens stock. And what we can do is we can take that stock and create what's called a covered call, which will create some income for them by doing that the proper way. And the risk is very minimal in doing that. Maybe having some structured notes. CD rates are starting to get a little bit higher. You can also get some structured notes that are paying some interest rates that gets a little bit higher rate of return without much risk. And then also maybe some reinsurance alternatives out there. So these are some things that the big leagues are using, and we're finding that by adding some of these into our clients' portfolios, we're getting the same results as they are. So how does your retirement portfolio stack up to here? So what we find is that many people are taking more risk than they realize. And one of the things that we want to try to avoid is that risk in retirement. So we've got a program called Riskalyze that we use that'll help you understand very simply a number between 0 and 100, what your level of risk is. But again, if we can control this bottom number to say no more than 6% as opposed to whatever that other number was, 26%, then that's something that we could possibly live with. And understanding that is a great way to know where you are. One of the tools that we have in our possession here is to help you understand that risk and run you through that program. So as a quick recap, IRAs, 401ks, 403bs, all these types of accounts can create additional tax problems in retirement. You need to get with your advisor team if you have one, and talk to them about it and find out how you can possibly eliminate some of these tax problems. If you don't have a team, obviously that's why we're here, while we're providing this kind of information to you. I'm going to show you here in just a second how we can give you a second opinion too to help you understand where you are. The other recap here is the new tax code does offer a window of opportunity. We don't know how long that window will be open, but we think for at least another couple of years. So there's some opportunities there. And then many investors are taking more risk than they probably are comfortable with. So hopefully this has been good information. It is a good time for you to get a complimentary second opinion. And how we can do that, we've got 3 ways that we can basically help everybody that's on the call today to kind of do this. Number 1 is we can set up a 30-minute coaching call with either myself or Troy or one of our advisors here to kind of talk about your current situation, see if there's any opportunity for us to add value to you, and that's free of cost to you. We can also do a 1040 tax review before year end. We still have time to do this. We can run one of those tax maps to show you what you're going to pay this year in taxes, find out if there's any opportunity to take money out tax-free before the end of the year. That'd be a great Christmas present for you to provide for your families. Take some money out tax-free so Uncle Sam doesn't get any of that. That would be great. And then number 3 is actually go through our retirement scorecard process, where we will sit down with you. We'll take a deep look into your current portfolio. We'll help you understand where you are currently, how that's going to be successful or maybe not successful over the next 25, 30 years. We actually do what we call results in advanced planning, where we run 1,000 different simulations of your current strategy, and we'll help you understand exactly how that's going to work and where it's going to lead you in the future. So hopefully that, like I said, this has been of value to you. You can call our office at the number on the screen, 502-253-9366, or you can go to mercurioadvisors.com. And either of those will give you an opportunity to take advantage of one of those 3 ways to meet with us. And really, it's kind of our presentation today. I'm going to open this up here and kind of see if we've got some questions. Let me see here. I can figure out how to get to the questions. Taylor, you may have to come back in here for that. There. Okay. So right now, if you want to ask a question, you can go to the side of your screen up at the top corner. I think there's a little opportunity to raise your hand and ask any questions that you have this morning. If you have any, we can sit here for a second and answer those questions. Again, I'd like to thank you all for joining me this morning. Hopefully you'll take advantage of all of the educational opportunities that we've offered. We are focused on 2019 and 2020, going ahead and providing a lot of content for you to really understand where you are in retirement. Whether we end up working together or not is not that's not what we have to have. We want to make sure that you are an educated client out there. There's a lot of good advisors out there that are doing a good job, but quite frankly, there are some out there that are just, more focused on selling products or selling investments. And if you build your plan properly, if you actually have a plan or a goal in mind, and you build that plan to accomplish that goal, then what you're going to end up finding is that the products will lead to themselves. You'll end up getting what you actually need to get there. So I got one question that's popped up here. Let me answer this here. If I want to share this webinar with a friend, how do I do that? Basically, you go give them the mwawebinar.com, and they can actually go in there and log in. and they can see all the webinars that we have on this topic and the future topics that are coming out. And we would certainly love for everybody to do that. If you have an opportunity to do that, share it with your friends. That would be great. Again, our goal is to educate as many people as we can about topics of retirement. So hopefully that is what you all end up doing as well. With that, I'm going to close up today. Thank you for joining me. Thank you for taking some time this morning and logging in. We appreciate your time and efforts, and we'll talk to you all soon. Thanks again.